So how can we actually predict future momentum just based on like how it's currently measured?
So this is where it gets really interesting. Remember that 12-2 definition? It looks at the returns from month T12 to month T2, and it actually excludes the most recent month, right, month T1.
Hmm.
And the reason it does that is to try and avoid sort of short-term reversals or bounces that happen right after a period of strong performance or weak performance.
Okay, so it's deliberately ignoring the latest month.
Exactly. But now think about the implications of that. That means at the end of month T1, we already know most of the data that will determine the momentum portfolio in month +1, right? So in particular, we already know the returns from T11 all the way to T1. That's 11 out of the 12 months that will define the next momentum calculation.
Okay, so by looking at basically the performance up to the month before the most recent one, we can already get a good picture of who's going to be the winner and who's going to be the loser in the next period.
Precisely. And this is not just like a vague guess. The research shows there are very high correlations between, current momentum rankings using slightly different timeframes and future momentum rankings. For example, if we look at the momentum based on the returns from month T10 to T1, those rankings have a correlation of 0.94 with the momentum rankings that we'll see 2 months later. And even if you look further out, so the returns from T6 to T1 have a 0.72 correlation with the momentum rankings 6 months later.
So what does this mean for you, the listener? Well, it suggests that momentum isn't just about looking in the rearview mirror. It's actually got some predictability built right into it. And this could affect how you think about holding these investments or how often you need to rebalance them, among other things.
Exactly. And this predictability is really the key idea behind these new strategies that we're going to explore.